Ever wanted to trade your view on the entire US stock market, but without the headache of buying 500 different stocks? Well, if that sounds like you, then you're in exactly the right place. Today, we're going to pull back the curtain on SPX options, one of the most powerful tools the pros use to do just that.
All right, so here's our game plan. We're going to start with the market's bellwether, the S&P 500 itself. Then, we'll dive into SPX options and how they actually work. After that, we'll cover the key benefits, and finally, we'll stack SPX up against some of the other alternatives out there.
Okay, first things first. Before we can really get into the option, we've got to understand what it's built on, right? The foundation for this whole conversation is the S&P 500 index. It all really starts with this number, 500. But the S&P 500 isn't just some random symbol on a screen. Think of it more like a carefully selected portfolio. It's 500 of the biggest, most influential US companies, all designed to give us a real-time snapshot of the entire economy.
And this is why you'll always hear people call it a bellwether. It's a leading indicator. So when you look at the S&P 500, you're essentially taking the pulse of the US stock market. And, by extension, you're getting a checkup on the health of the entire economy. It's also capitalization weighted, which is just a fancy way of saying the bigger the company, the more of an impact it has on the index's value.
And you can really see its importance when you just look back through history. Seriously, since it was introduced way back in 1957, this index has been a mirror to our economic story. It felt the shockwaves of the tech bubble bursting, it reflected the absolute trauma of the 2008 financial crisis, and it perfectly captured that insane roller coaster of the COVID-19 pandemic. The sharp fall and that furious recovery. It's basically a living history of the market. So now that we've got a good handle on what the index is, let's look at the actual tool that's designed to trade it, the SPX option.
At its core, an SPX option is really just a contract whose value is tied directly to the S&P 500. It's a way for investors to hedge, to speculate, or even to generate income based on the movement of those 500 companies. And here's the best part, without ever having to own a single share.
And this right here, this is the most important thing to remember. With SPX, you are not dealing with actual shares. You are trading purely on the numerical value of the index itself. So you think the S&P 500 is going to move from 4,500 to 4,600? This is how you can trade that belief directly.
Okay, let's pop the hood and see how this thing really works. To really understand SPX, you need to know its core mechanics. These are the key features that make it so different from other options you might have seen.
First up is the multiplier. It's $100. Every single point in an SPX options price is worth $100. So, if a contract is quoted at, say, $5.50, the actual cash cost is $550. Simple as that. Next is the exercise style, and believe me, this is a total game changer. SPX options are European style. What does that mean? It means they can only be exercised on their specific expiration date. Now, for anyone who sells options, this is huge. It completely eliminates the risk of being assigned early, which gives you absolute certainty for the life of the contract.
And that European style leads directly to this. Settlement. SPX is cash settled. At expiration, there are no shares to deliver or receive. The whole thing is settled purely in cash. The difference between the index's value and your strike price gets multiplied by that $100, and that amount is either credited to or debited from your account. It's so clean and simple.
So, we've covered the what and the how. Now let's connect all those features to the why. Why do so many sophisticated investors and institutions choose SPX?
Well, the advantages are pretty significant. Strategically, that European style and cash settlement give you certainty by getting rid of early assignment risk. And from a financial point of view, you get two massive benefits. There's potential tax advantages and there's incredible capital efficiency because the contracts are so large. Then you combine all that with nearly 24-hour trading and a huge range of expirations, and you've got an incredibly versatile tool.
So how does the SPX stack up against the other ways you can trade the S&P 500? This is really the final piece of the puzzle. Let's put them side by side.
This table really lays it all out. Look at SPX versus SPY, the really popular ETF. The size of just one SPX contract is about 10 times larger. That's what makes it so capital efficient. And notice the key differences we've been talking about? SPX is cash settled in European style. SPY options, on the other hand, deliver physical shares in their American style, which means they can be exercised at any time. Now, if you want all the features of SPX but in a smaller package, that's exactly what XSP, the mini SPX, is for.
Ultimately, it all comes down to this. For anyone who wants to directly and efficiently manage their exposure to the broad U.S. market, SPX provides a uniquely powerful set of features that are honestly pretty hard to find anywhere else.
And that brings us to our final question. We've explained the instrument, its mechanics, and its advantages. But the real question is for you to consider. Now that you understand this tool, how might it fit into your own approach to the markets? Thanks for joining me.